Hello everyone, my name is Vinny Racile. I'm an instructor with Accounting 1040. This is a tutorial on E10-14. We're going to work through this problem and all of the steps to help you understand how to break down a problem of this type. So let's get started. First thing, I'm going to switch screens so that we can work in Excel and you can see the problem in greater detail. So let me start with that. And then you can see some video as well. So hopefully this helps you. All right, so let's just make sure you've got the right screen. Yeah, and we're all set to go. Perfect. So we're going to read through the problem first so that you have a good solid understanding of what the problem is telling us, and then we'll break through the steps. So we'll work through the steps. E10-14. So this is about Triad Freight, which is a large warehousing and distribution company. They operate through Eastern Canada. Triad Freight uses the U of P method, units of production method, to amortize its trucks because its managers believe this method best measures the wear and tear on the trucks. Triad Freight trades in used trucks often to keep morale high. Let's look at the facts. They acquired the tractor trailer rig in 2016 at a cost of $585,000. They expected the service to be, or remain its useful life, to remain for 8 years or 1.5 million kilometers. Estimated residual value, $60,000. Then this goes into a series of kilometers per year that the truck was driven. So first year, 150,000 kilometers. This should say 2017 since the truck was purchased in 2016, 195,000 kilometers in 2018, and so on and so forth. 2020 comes, and after driving it 100,000 kilometers, the company's trading in the Mack truck for a Freightliner rig, which is a different type of truck, with a fair market value of $510,000. They did this on August 15th. They paid $40,000 of cash with the trade-in, and they believe this is going to reduce their operating expenses. So what's required? Determine the cost of the new truck, essentially, and prepare the journal entry to record the trade-in. So this is an overview of the problem. Let's get started on the steps to solve the problem. So what I'd like to do is I'd like to break this down in a series of steps for everyone, just to help everyone understand how to sort of go after these types of problems when you see them in a testing scenario when you're practicing. So the first thing is try to get the facts down and jot it out of the problem. So you're reading through this small paragraph and you want to be able to pull the key facts that you need to solve the problem into one area. So what I've done is I've provided a list here. We have some information about the truck cost, the date, expected life, expected kilometers, residual, which is salvage, same thing, how many kilometers they've driven by year, the fair market value of the new truck, the date it's acquired, the cash paid, and then the requirements. So again, just reading through the problem the first time, second time, skim through, pull this information as the information you're going to need, and then start filling it in. So $585,000 is the cost. It was acquired 2016. Expected life, it tells you, of 8 years. Expected kilometers, it tells you 1.5 million, residual value $60,000, and then it gives you a series of these kilometers used by year or driven by year. So let's fill those in. Then we have a fair market value of the new truck, which is $510,000, the date of August 15th, how much cash was used, and then the required. So now you have all your facts in one place to reference. You don't have to keep rereading the problem over and over again to find every single step. Let's go to step 2 of this problem. So I'm just going to unhide this information here for us. So the second part to this problem, or the second step involved, is to update the amortization to calculate the cost of the old truck. So what method of amortization are we using? We're using units of production. And how do we know that? They tell you right in the problem. So there's no need to look further than the problem itself. So once you know it's U of P, you then basically need to break out the formula. This requires some studying and memorization. So the formula in this case is cost minus the residual value multiplied by the kilometers used each year divided by the total expected kilometers. And then that's going to give you the accumulated amortization up to the trade-in point. This is not the same as amortization per year. You're accumulating all of the amortization up to the point you decide to trade in the truck here. So just want to emphasize, this is the total total kilometers used each year added together. So let's plug in the numbers. We have the cost here of 585,000. That's given to us right at the top. We have the residual value of 60,000, again given to us here. And then we proceed to add into the numbers of kilometers by year. So these are all numbers that I've referenced right up here and just added them together, divided it by the total expected number of kilometers, which is right here. The calculation of the formula is basically broken out here for you. If you double click onto the cell, you'll see I've basically dropped the formula in. So it's cost minus residual multiplied by this formula of adding up all the kilometers used divided by the total expected kilometers. We come up with a number of $238,000. So that's the accumulated amortization of the truck. The next step here is to now calculate the book value. So let's unhide this step here. So how do we calculate the book value? We have cost minus accumulated amortization. Very simple. Cost is given to you at 585,000 minus the 238,000 that you just finished calculating. The total, one minus the other, is $347,000. This is the book value of the old truck. So now that we have that, we're trying to calculate the gain or the loss from the sale. What is it we're trying to assess here? Just take a step back before we move through formulas and then really try to take a look. In the problem, they stated that we purchased the original truck for $585,000. There's some amortization that's gone on to reduce the value. So the book value being $347,000. That is the book value of the old truck that we're using to trade in for this new truck. The true new truck's value is $510,000. In order to get this new truck, we've traded in the old truck at $347,000, and then we've paid an additional $40,000 of cash. So what we're trying to assess here is really, did we get a good deal on this truck? Did we make money, or did we lose money on this trade-in transaction? That's what we're trying to figure out in this problem and scenario. So let's go to step 4 to figure out whether we did make or lose money on this. The making money or losing money on the transaction here is referred to as a gain or loss on the sale of the old truck. So how are we calculating that? We have the cost of the new truck at $510,000 minus the net book value of the old truck, which is the $347,000, which was calculated just above. We're going to deduct the cash paid for the new truck of $40,000, which is given in the problem again, and that's going to equal our gain or loss. The number is positive, which indicates it's a gain. So all I've done is deducted all of these from the cost of the new truck. If the number was a negative, this will be considered a loss. So now we know that in this transaction, in this trade-in transaction, even with the cash, the company has actually made money on this transaction. So let's then go ahead and then record the journal entries, which is the last step here. So when we're recording journal entries, I think the key thing you need to remember is you need to have something to account for each occurrence that's happened here. And so I've tried to break this down so that you can have sort of a checklist. The first entry is the purchase of the new truck. The second one is the removal of the old truck and its associated amortization off the balance sheet. The third is to record the gain or the loss on this exchange. And then the fourth is to record any cash that's been paid out. You can sort of use this as a guidance, but just make sure when you're trying to record the entries, you're thinking about everything that's occurred here and then where that resides in the income statement or the balance sheet. So let's take a look at this entry. We have the date of August 15th that's given to you. We have the debit of the new truck for $510,000. Why is it 510? Because that's the fair market value that was given in the problem. And what are we doing? We're adding this asset to the balance sheet. That's why it's a debit. We've got accumulated amortization of the old truck of $238,000. That comes from the problem right up here. Why is this a debit? Well, this account normally sits in a credit balance, but to remove this accumulated amortization from the balance sheet, you need to basically record a debit to clear this out. Why are you doing that? Because you no longer own the asset or the associated amortization. The next transaction, or the next step, is the gain on exchange. It's $123,000 as you've calculated above here. Why is this a credit? This is not an expense. The gain is recorded as sort of other income, which is a credit balance. Cash of $40,000, this is given in the problem. Why is it a credit? Because you paid for cash and not deposited it. And then the last one is basically the disposition or the removal of the old truck from the balance sheet. And that's a credit of $585,000. This is sitting as a debit balance on the balance sheet, and so you're removing it from the balance sheet because you no longer own it. So let's just recap the steps that we've used here. The first thing is we've recorded the facts and jotted those down in a summary, so we have that as a reference point. The second thing we've done is we've updated the amortization to calculate the cost of the old truck. We've then calculated the book value, and then we've moved to trying to figure out, did we make money or lose money on this transaction? And then the last step, of course, is the journal entry. Key thing with the journal entry to check is make sure that the entry balances. This adds up to $748,000. Let's check the credit side. Again, $748,000. So you know you've balanced the entry, and you know it's probably correct in that situation. So hopefully that helps you understand how to break down a units of a production and an exchange asset problem. And you can utilize these steps when you're practicing your further problems in your studies.